Okay, let's continue our discussion of ratio analysis and take a little closer look, another way that we can use these ratios. And remember that when we're talking ratio analysis, we're comparing one thing to another in order to learn something about that relationship. And then when we do several ratios over time, we can see how that relationship changes or how the relationship stays the same. It's just another example of financial statement analysis where we're making really pretty basic calculations, basic manipulations, changing the numbers to get some additional information. Now, up to this point, we've really been looking at single ratios, right? We looked at, really, we were doing ratio analysis when we did common size statements and turned everything into percentages because the ratio was between each asset and total assets, or each liability and total liabilities and equity. So that is a ratio. And then we looked at the 6 ratios from last time, the 6 basic ratios, comparing one to another. For example, the current ratio, comparing current assets to current liabilities, pardon me, to get an idea of how those things relate to each other. I want to take that a step further and look not at just one ratio at a time, but rather 2 and even 3 ratios at one time to see not only how the 2 things in a single ratio relate, but how everything in these multiple ratios relates. And to do that, we're going to look at a couple additional, actually 3 additional ratios. So when I said we were going to do 6, it really ends up being 9, but bear with me. Okay. So I'm going to share that same handout from last time, and we're going to take a look at something called DuPont analysis, or the DuPont equations. Okay, so this should look familiar. Comparative balance sheet and income statement over on the left, common size statements down below, and here on the right are the ratios we've been looking at. All right, we looked at the 6 ratios last time, talked about what they mean, how to relate to them, how they relate to one another, and what they tell us about this comparative balance sheet. Now I want to talk about DuPont analysis and 2 additional ratios. All right. The first ratio is return on assets, or ROA. And as you can see, the formula for ROA is just net income divided by total assets. Net income over total assets. Now that's very similar to the total asset turnover that we looked at earlier, isn't it? Total asset turnover was sales divided by total assets. And the concept was that the reason the company owns assets is to generate sales. So total asset turnover is a measure of how well or how efficiently the company is using its assets to generate sales. Return on assets, or ROA, is kind of a closer look at that, and not how assets are being used to generate sales, but rather how assets are being used to generate net income. And if we talked about before, net income and sales, of course, are on the income statement. Sales is at the very top, net income is at the very bottom, and everything that happens in between is expenses. So we go from sales to net income by subtracting all the company's expenses, so that instead of looking at how well do assets generate sales, we're including those expenses, in a sense, to look at how our assets are generating net income. It's It's like we're looking at how well are the assets being used, total asset turnover, asset management, and then how are sales making it down to net income, right? That's also a ratio we've looked at, isn't it? It's the net profit margin. How much of sales are making it down to net income, right? So we're not just looking how sales generate, assets generate sales, but in addition, how much of those sales are making it down to net income. So there's an asset management aspect and there's a profitability aspect in this ratio. That's the whole point of DuPont, the analysis or DuPont equation, is that the DuPont equation takes return on assets, net income over total assets, and divides it into two parts. Right? So you see, sorry, that's hard to see. So you can see that, right? We have return on assets, net income over total assets. And then it says that equals net income over sales. Well, there's our profit margin. There's the profitability piece. How well do sales make it down to net income? Times sales over total assets. How well are the assets generating sales? Total asset turnover, asset management. And the way this works is, all the way back to whenever it was we started learning about ratios, that whole sales below the line, sales above the line, right? Net income over sales, sales over total assets, below the line, above the line, sales cancel sales, and we're left with net income over total assets. Net income over total assets, there's the ratio. So that's the point of the DuPont analysis. It's not the return on assets. That's a simple ratio. It's about taking it one step further and recognizing that return on assets has a profitability part and an asset management part. Right? And we use our profit margin, net income over sales, to measure the profitability piece, and our total asset turnover, sales over total assets, to measure the asset management piece. Right? Now, this would be a ratio of particular interest to stockholders who have given the company their money, right, in order for the company to generate net income. Because remember, the company has a choice, two things that they can do with their net income. They either pay it to the stockholders as dividends, and that's obviously something the stockholders are going to be interested in, or they keep it and reinvest it in the company as retained earnings. Retained earnings then should generate additional sales, additional net income, and additional dividends. So this is all of great interest to our investors, our stockholders. Right, so the idea is, instead of only calculating the return on assets, and here that is, we can calculate the two pieces, net income over sales, that's the profitability, and sales over total asset, that's the asset management. Multiply them together and get the return on assets. So let's take a look. For the 3 years in this comparative balance sheet, what happened to our return on assets? Well, it started at about 6%. It dropped off sharply in that first year, dropped down to less than 1%, and then rebounded to 7.25%, more than it started. So return on asset, big decrease, and then a big increase. DuPont analysis asks the question, which caused that, profitability or asset management. So let's see. We'll look at the profitability part. Well, it started at just over 2.5%, jumped way down to below 1%, and then rebounded to 3.6%. Exactly the same pattern as ROA. All right, they both took a big decrease in the first year and rebounded in the second to be more than they started. How about the asset management? Well, asset management we see decreased kind of steadily over the 3 year, but didn't have that big jump down and jump back up again. So looking at the individual parts, looking at the asset management, that seemed fairly steady, decreasing, but fairly steady, but the profitability was all over the place. So which of the two more likely is responsible for the changes in ROA? Well, clearly the profitability. Now, let's remind ourselves what was going on with this company that might have caused that profitability change, right? If you remember, let me scoot over here. If you remember, we identified that in the first year, the company bought a lot of assets. Fixed assets tripled. Inventory almost doubled. So they bought a huge amount of assets. And they paid for it with long-term debt that tripled, and notes payable, right? That went up by almost 4 times. Big increases in debt. And of course, with that debt comes interest expense. So they borrowed a bunch of money, but that just means they have to pay interest on it. And we see that here in the income statement. Interest expense almost tripled. All right. So as far as the ratio, what happened was we had a big increase, a big decrease in that net income because of all that interest expense, and that pushed the ratio down. In the second year, however, the notes payable decreased, so they paid off some of those notes. The long-term debt dropped by half, so they paid off half of that. Where did the money come from? Well, what they did was they sold stock. They sold stock, right? Stock was at 460, and now it's at 1.6 million, tripled. And they sold stock and used that money to pay off the debt, which means all that interest expense went away. Well, not all, but the interest expense dropped off again. And here you see it. It dropped off by half. So that in the second year, the net income rebounded because that interest expense went away and the ratio increased. That, in a nutshell, is what DuPont analysis is intended to do. We take this ratio that investors are going to be interested in, return on assets, and we break it into 2 parts, a profitability part, an asset management part. And then we see, looking at those ratios, which one was it that caused changes in the overall ROA. In this case, it was clearly the profitability. So now we're looking not just at one ratio, but at 2 to get at different aspects of the return on assets. Well, we can take that even a step further and talk about something called return on equity, or ROE. Return on equity is net income divided by total equity, right? And just as a reminder, if we look at the balance sheet, total equity is common stock, paid in capital, and retained earnings. If our company had preferred stock, that would be in there as well. but there's no line for preferred stock. So this company hasn't sold any. All right. So the total equity, preferred stock, if they have it, common stock, paid in capital, and retained earnings. It does not include liabilities, right? It doesn't include any of the current liabilities, and it does not include the long-term debt, right? If you added long-term debt, then you'd have capital, but that's not what we're measuring. We're measuring net income versus total equity. All right. So what is the return on equity, pardon me, trying to measure? Well, equity is the investment that our stockholders have made in the company. That's equity. The investment that our stockholders have made, the ownership that our stockholders have in the company, right? Either by buying preferred stock or buying common stock, or by allowing the company to retain part of the net income. All right, so why are stockholders willing to invest this money? Well, in order to earn a return, and that's a phrase we're going to use a lot over the semester, to earn a return. Right? And specifically, the stockholders, what is it that the stockholders want out of that net income? Because that's their comparison, right? Their investment to the net income. Well, as I've said before, net income either goes to the stockholders as dividends or stays with the company as retained earnings. In either case, they're generating some sort of return for the stockholders. So the stockholders in ROE are looking at how much return, net income, is our investment generating, right? Equity, that's what the stockholders have invested. Net income, that's the return that's then available to. Okay. Well, that's really close to ROA, right? And close in its DuPont analysis, because we take that return on equity ratio and divide it not into two parts, but into three, right? Notice the first part is net income over sales. Same rate or profit margin as before. There's the profitability piece. Excuse me. Sales over total assets. That's the total asset turnover, just like before. Asset management part. But now the third ratio is total assets over total equity. Notice there are no liabilities thrown in here. This is just assets and equity without the liabilities. And this third ratio here is called the equity multiplier. Right? And the equity multiplier is the comparison of total equity, that is, preferred stock, common stock, paid in capital, retained earnings, compared to total assets. We play the same kind of a game. Sales below the line, sales above the line, so they cancel. Total assets below the line, total assets above the line, so they cancel. And we're left with net income over equity, and that's the ratio. Right, and down here below, I've done the calculations. Right, first is the profit margin, and that's the profitability piece. Then we have sales over total asset. That's total asset turnover, and that's the asset management piece. And the third one, that's total assets over total equity. That's the equity multiplier. You can think of it, how well is the equity being used to generate assets? Okay, the analysis then works the same way. Let me highlight that, make it easier to see. The analysis works the same way. Let's see what happened to ROE. And this ROE line is just net income over total equity. Was it about 13.25%? Then it dropped off to 4% and then jumped back up to about 13%. Well, that's a pattern we're used to seeing with this company, isn't it? And this set of data, right? Big decrease in the first year and a rebound in the second year. Right? We know from what we talked about just a minute ago, that's the pattern we see with profitability. 2.5% down to less than 1%, back up to about 3.6%. Big decrease, big increase. That's because of they borrowed all that money and paid a lot of interest expense in the first year, and then paid off that debt with equity and got rid of that interest expense. That's why it jumped down and back up again. Asset management, total asset turnover, like we talked about a minute ago, that's pretty constant. It's decreasing, but not that dramatic jump up and down that we've seen before. The equity multiplier, however, notice it has those big jumps, but in the opposite direction. Right? Instead of starting and jumping way down and back up again, it starts and jumps way up, more than doubles, and then jumps down and ends up lower than it started. So what happened? What happened? Well, what happened was in the first year, right? In the first year, the company took on a whole bunch of debt and used it to buy assets. Right? That's assets and liabilities. Well, the assets are here in this ratio. That's the numerator. So the numerator got much bigger, but the liabilities aren't here. What's here is equity, and the equity stayed the same, right? You see it from that first year to the second, that common stock and paid in capital, that stayed exactly the same. Retained earnings decreased, but common stock stayed the same. So we had an increase in assets and actually even a decrease in total equity, and that pushed the ratio way up. Right? In this first year, the assets compared to equity increased a lot. But then if you remember in the second year, the assets stayed about the same. It's an increase, but not huge. But the equity increased because they sold stock in order to pay off the debt. So in the second year, assets stayed about the same, no big increase, but the equity had a big increase. The denominator of this ratio increased and pushed the overall ratio down. So what is it that caused the overall ROE to show these big jumps? Well, clearly profitability had something to do with it because it showed the same jumps down and up. Probably not so much asset management. That even though it decreased, it didn't show that same fluctuation. But the equity multiplier was in there as well. Right? In the first year, they took on a bunch of assets without changing equity. So that raised the ratio. In the second year, the assets rather stayed close to the same, but the equity increased, and that pushed the ratio back down again. DuPont analysis isn't necessarily to tell you exactly what happened, but rather where to look. Right, and you can see that here in this ROE. Probably we don't need to worry about our asset management. That's fairly steady, but profitability and the equity multiplier, there's where we need to look to see what happened. Okay, well, for me, I find ratio analysis a little difficult to teach because so much of it has to come with practice, and so much of it is more than of an art than a science. Calculating the ratios themselves, there's nothing to that. Put it in a spreadsheet, type in a formula, you've got it. Right? Copy it and drag it, and you've got it for every year. No big deal. The more challenging part is figuring out what it means. And that's the art rather than the science. Right? Most of the time in this class, we can talk about here's the problem, here's the way we work it, and here's the answer. It's not quite that simple with ratio analysis, right? Here's the data, here's the ratio. We can talk about what it means and how to look at it and how to compare, but figuring out what the answer is, what it's telling us, that takes practice. Okay, as always, let me know if you have questions. I'll get back to you as soon as I can. Thanks.